Craig, let's talk about the process of approving the borrower and the deal, because those are two separate things,
absolutely.
really. Okay, we will get a loan inquiry, and most of that comes from speaking engagements. So a lot of people hear us over the course of a year, and then they may go to the website and fill out a loan application, or something online they read, and we end up with getting a loan application. And what is the initial screening that goes through your mind as you see an application?
Yeah, the first thing we do, and we get, it's a very brief application that we get, and I just break it down into pretty much two parts. The first part is credit, and unlike a bank, I'm not necessarily looking for a particular score, although I do get what their credit score is. I'm just trying to get an overview. One question I always ask them, because I think this is very telling, like with their revolving debt, for instance. If they have $100,000 available on their credit cards, do they owe 0, do they owe 50, or do they owe 99?
Right.
Because the person that owns 99 is calling me because they have to buy a house so they can sell the house, make a profit, and pay down their credit cards.
Right.
You can just kind of see where they're coming from.
And that's really not the person we're probably going to say yes to.
We just won't, because that's the person that's going to make a mistake. And then when you go into phase 2, we look at their cash reserves. Mm-hmm. That's also the person that's going to be low on their cash reserves, or they wouldn't be so high on their credit cards.
Well, it's interesting. Do a lot of speaking, and sometimes at clubs they'll have the pre-event where people get up there and kind of talk about their wares, and one of them will always be a hard money lender who says, we don't care about credit, we don't care about anything other than equity. And over the years, I've learned from you that that's not a good decision.
It's really not, and it couldn't have been any more evident over the last, from 07, 06, 07, 08, because companies that made too many loans without looking at credit and cash reserves probably aren't around to make loans anymore.
That's right.
And we've always done that because we just want a successful transaction.
That's a good point. We never make a loan saying, boy, I can't wait, if this person defaults, we get to end up with that property. That never, ever is a part of our decision.
No, and we can always make a safe loan.
Yes.
Because if somebody's paying $150,000 for a piece of property, well, there's always a loan that'll make our investor safe.
Yes.
But if the guy's paying too much, he's paying too much. And I know you've heard me numerous times. I will spend 10, 20 minutes with the guy just telling him, listen, are you sure you want to do this? Because it's just people sometimes get excited and they just see things how they're not.
I think people would be surprised at how many times we say no a month as opposed to yes.
Yeah,
it's more no's than yeses.
It's probably 75-80% no's, if not more than that.
What's good thing about the no, though, it's most often in not only the interest of our lender base who would have put up money in harm's way. Those people are getting into a business they're not capable of knowing the outcome, and we prevent that.
Exactly, and our whole goal, just with the education and everything, we don't want to make one loan to somebody and whatever happens. We really want to make multiple loans to somebody that's successful. And a good example is a client that does a lot of business, I won't name names, but does a lot of business with his dad currently. Mm-hmm. And I didn't even realize it until he mentioned it down the road, but he had called me and I told him to get out of his first deal.
Okay.
And now we've done probably, 25 or 30 loans this year with that particular father-son combination. And I think they're as good a buyer as we have, yet the first deal they got out of. So you just never know. If they buy that first deal, lose money, it might sour them on it, or... Well,
it may take the nest egg.
Yeah.
And also, there's definitely people in the family watching. So you lose money on the first deal, it's a little hard to get the go-ahead on the second one.
Exactly.
Okay.
Exactly.
So we've now screened the borrower, and so here's this deal. So how do we go and say, okay, yeah, that's a deal?
Well, basically, we're going to look at the property. One advantage we have an appraiser that is actually a property investor himself, so he can go out and look at a property, analyze it. We're going to look at things that maybe a lot of the clients won't, and just try to mention a few to be quick. Like a lot of times there might be an average lot size in an area of 8,000 square feet. Mm-hmm. Okay, well, this client comes to us and says, I have a house that's worth $200,000 and here's all the comps. Well, all those comps have 8,000 square foot lot sizes.
Right.
Ours has 3,900.
Right.
Okay, ours is a lot less desirable.
Absolutely.
So a lot of times there's location problems that they're not thinking of, behind commercial. Just they just get caught up because they're excited. It's almost like driving to Vegas or something. I mean, they can't wait to get there and make money.
Mm-hmm.
So much so that they're like not really looking at the actual details of the deal.
Right, and so in that appraisal process, we do say no then on occasion.
Yeah, not as frequently as
Right.
on the phone. It keeps getting less and less, but each time it's a weeding out process. And a lot of times, with all the new technology, I mean, I'll send the information to the appraiser. He'll do an overhead view, and a lot of times you can notice something in that overhead view that's going to tell us that's not something that we want to lend on.
There's a lot of things that are automated now, and I just thought of this. You pull up comps from a computerized source, and
Right.
a lot of times it's to the new investor, they're trying to prove a value, and they find these numbers, and they go, okay, we've got 140, 150, 155, and 180 and 200,
Right.
and they just want to float to that 180 and 200 and
Right.
say, I'm going to fix it, I'm going to get there. But then you find out, well, wait a minute, those sales didn't even happen. Those were trustee sales at full value. In other words, with
Right.
an experienced appraiser, he's able to cut through that and go, man, you are not going to buy that or sell that at 200. I just saw a fax that came over, and it was thanking Rick because it was exactly that scenario. This person had said this is, and an experienced person, so it's not just inexperienced.
No, I think people should know. I think we get thanked more
Yeah.
for the times we say no than all the thousands of loans that we've done. So it's those people that are really appreciative for us telling them why this might not make sense.
Yeah. Sometimes when people don't know us, they have the opposite. So it's hard sometimes to say no to somebody that's been driven around in a bus store, and they spent all their money on the training, and they show up at the office with $2,000 left and go, okay, I've been told you can get this with no money down. It's just
Yeah, unfortunately, I mean, I'm in that position. I
Yeah.
mean, I say no a lot. And how I've justified it for myself, it's a lot easier having them a little frustrated going in than telling them something that just doesn't make sense at the end and changing it or having them get in a bad deal. Because that's when you really have angry people, if they get into something they shouldn't be in.
Yeah, and fortunately as a company, we've never been in a position where we've had to say, okay, we need the money in a commission this month,
Right.
so we'll make this marginal loan. We just don't do it.
Absolutely.
Preliminary title report, let's talk a little bit about
Yes.
what's on those and what would be something you would look at as a red flag.
Well, basically with the title report, you're going to just get information like who the owner is. In most of the cases now, that owner's a bank that's taken back a property.
And that really simplifies things.
It really does, as you know, because one of the hardest things when we're in a different cycle, just to touch on it briefly, you're dealing with homeowners
Right.
that are selling houses, and it's almost never what they say it is.
That's right.
If they say they have a first where they owe $90,000 on it, they probably owe $102,000. So it has who the owner is. It shows the deeds, if there are any deeds on there. Once again, in a bank situation, most of them are free and clear.
Right.
But maybe more importantly, it also shows if there's liens such as abatements, which
Yeah.
is basically something that would say that money's owed on this because the city's done something. Maybe it's a substandard property.
Let's explain that
Yeah.
just for a second, because
Yeah.
that could be a problem.
Yeah, it can be. Substandard property could be anywhere from something structural, where they might be in danger of tearing it down,
Right.
which we know is very rare.
Right.
But you still would want to know that
Sure.
before you lent on it or bought it.
Yes.
All the way down to something like there were weeds that were overgrown and the city came and cut them down. So frequently, probably I would say on maybe 25% of the houses, there is some kind of substandard that we have to review and look at. And most of the times, it's not an issue because the client's going to buy it and fix the house up anyway. It's something that we're already aware of.
Now, most of the time, we go through most of all of this before we call up the trustee investor and say, here's...
Yes, most of that is either in process or done by the time the investor maybe hears about it before it gets to a final point. Absolutely, that's been done.
So then at that point, how do we present the trust deed investment opportunity to the potential trust deed investor?
What we do with most of the new investors that we have, luckily with email, it's real nice. The appraiser will send over the appraisal. So I have an appraisal that's in a format that I can just email to somebody. I email them with a little synopsis of, this is what the house is worth. Here's what we're going to lend on it. This is the loan to value, which we touched on. Should I mention that again?
Sure.
Loan to value, basically, something might be worth $200,000. If we're lending $125,000, what loan to value means, that's like 62.5%. And we'll never be over 65 right now in this market.
And by the way, that's an important thing to know, that can change a little bit, both more conservatively or more aggressively, depending on
Absolutely.
the trajectory of where we know things are going.
Yeah, absolutely. So that does have some flexibility in it. So we'll talk about the loan to value. Usually I make a notation because so many borrowers are repetitive. I might say something like, this is a repetitive client that we've done a lot of business with. So I just give them kind of an idea what the investment will be. Usually they take a look at that and give a tentative yes. A lot of people, especially new people, will go out and take a look at the property, which we always try to give them time to do, especially when they're new investors. And from there, it's pretty much they make a decision.